What are the stocks I'm most worried about after this amazing comeback? Which are the ones that need to be sold into the strength of a second day that I expect? Sadly, the ones that have to go off and have the backing of the youngest cohort, known as the CNBC Next Generation 50. The list is chock-a-block with securities, not just stocks, but securities like Ethereum and Bitcoin, even if their proponents like to describe them as currencies. And yes, according to SEC Chairman Gary Gensler on our show, these are all securities, even the squirrely Dogecoin. I try to address stocks in this index endlessly, and not just because I had a hand in choosing the members. It's also because many of these stocks had to be booted into any further rally. Why? Well, you've heard me say it, but it's worth doing it again, because unfortunately, late November, the Federal Reserve decided to crack down on inflation. And as I've been saying over and over, many of these stocks in the Next Generation 50 suddenly went out of style in the Wall Street fashion show. They need the Fed to greenlight. Since then, this group is littered with losers, many of which have to be sold. But I dove into this weekend to identify some that might be worth buying, and I identified a few. Now, first, let me just tell you my criteria. I'm only interested in companies that can turn a profit this year because everything else is hated. I also eliminated the obvious. You don't need me to tell you about Alphabet or Apple or Tesla or Chipotle. By the way, we own the first two for the charitable trust. On top of that, I booted any company that's expected to have a down year or sells at an astronomical price to earnings multiple, not just price to sales. I have no interest in those. You know what? That leaves just 10 companies. 10 companies out of CNBC's Next Generation 50. 10 that have value using the investing club criteria that I like to follow, which I refuse to deviate from because it's treacherous out there if you don't have any discipline, and the investing club's about discipline. My favorite, my number one, is Palo Alto Networks. Yes, the king of cybersecurity. It's a stock that showed its true colors when it exploded higher today. It was among the first 10 stocks in this market to turn after the crescendo that I keep talking about. When Steve Nikesh Arora took over a few years ago, Palo Alto was considered way too centered around what's known as on-premise software, meaning they neglected the cloud. Since then, after a series of acquisitions, they've become the number one cybersecurity player in both on-premises, meaning the main building, and the cloud, which is also great for the work-from-home people. In a world where more and more people are working remotely, businesses need Palo Alto to protect their overextended networks. This is real, okay? This. My second favorite in the Next Generation 50 index, I like Airbnb for the reasons I mentioned last week. It's been a winner during the pandemic with real staying power because renting a place on Airbnb is safer and cheaper than staying in a hotel. This is one of those companies that's really a technical one. Okay, which is why it's so much easier to use. Their platform is so good. It's better than the competition. Airbnb software is its strength, not just the list of rental properties. It's the software that makes it proprietary, easy for both sides. Nobody's going to stop these guys. And it will make plenty of money this year, not just because CEO Brian Chesky has decided to stay in a new one every couple of weeks. I like that guy. Third, you now have my blessing to buy DoorDash, because it turned out that, like Airbnb, DoorDash has taken permanent market share since the start of the pandemic. I think people have learned that they like getting food delivered more than they realized. It's cheaper, by the way, because you can buy the liquor at home. And COVID has given you a permanent increase in the number of available options as restaurants had to adapt or die. Don't take it from me. Take it from the receipts at Bar San Miguel. That's my small plate Mexican place in Brooklyn. We want people to come into our bar. We make all our money on Pacifico, for heaven's sake, or Mezcal, as do all the purveyors who serve alcohol. But we're resigned to the success of DoorDash and grateful, as are many other restaurateurs in Brooklyn, that they actually gave us a break. They did. They said, small restaurants, we're going to help you. Okay, number 4 is controversial because it just keeps going down, and it's about to go higher, and that's Etsy, another Brooklyn-based company. A couple of months ago, Etsy was at $307. Now it's been cut in half, falling to $154, thanks to the sell-off in high-flying growth stocks, kind of like PayPal, more than that in a moment. Etsy's been punished because investors have decided that their business is too linked to the pandemic. Once we get through this horrific Omicron stretch, the sellers are convinced that the people who create and sell product on Etsy will go back to work at regular jobs. The great hiring, the kind that gives you health insurance. I think this is the same thing that's ailing Shopify, but in the end, I doubt that will be enough to derail the story, nor do I feel that the news about Shopify and what it's doing with fulfillment is necessarily the death knell of Shopify, but that's not my point here. Fifth is PayPal. Now, PayPal, my travel trust owns PayPal, and I'm going to just do a little remonstration for a moment because I like Dan Schulman, You wake up in the middle of the night, do you think about Mahomes? Do you think about Allen? Do you think about Jimmy G? You think about how stupid you were to buy PayPal. It's become a caricature of this decline. It's a stock that sold north of 50 times earnings before the fintechs collapsed. What was I thinking? Now it seems destined to trade down to the same price-to-earnings level as the big banks. Maybe 10 times earnings, even though it's growing at a 20% clip. Okay, maybe 18% this quarter. In truth, when you see a stock get hammered like this, it means either the growth is going to slow much worse than the analysts expect, or the sellers are just dead wrong, and you need to buy it in a weakness. Well, guess what we did for the charitable trust? The haters who used to love PayPal now think it's going to 130. We bought some. What can I say? Wrong, high, I think righter, lower. All right, 6 is one that a lot of people just keep missing. That's Crocs, okay? Now, if Crocs hadn't spent $2.5 billion on Hey Dude, you bought Adele. Oh, no, I'm sorry, it's just Hey Dude, another shoe company. It would have been my first picker. But there are simply too many shoe companies, and Crocs didn't need to make this acquisition. Now, it'll be watched for its integration, for its competitive edge against a bunch of shoe competitors that have come public, like Allbirds, ones that already have lost the enthusiasm in the stock market, and frankly shouldn't have come public, but managed to managed to be able to make some money. Number 7. Oh, boy, this one is a short squeeze. Upstart. The financial technology company that allows lenders to assess borrowers better than your FICO score. The market's turned against Upstart with a vengeance, and the stock has been obliterated. I'm a big believer in their technology, but I've been telling you to be careful with this one because financial technology is toxic right now. Some smart company will buy Upstart if it stays down here, though. Yes, these are two that I'm really going against the grain on. This is against the grain because it's linked to the now hated Shopify. The others, well, some people think this is just entirely pandemic. That's definitely wrong. I don't have a negative on this one. That's why I listed it first. Okay, now let's go to 8th. 8th is one, so many people call in on the lightning round. They want to know about solar. They want to know about batteries. They want to know how to make money. Okay, Enphase. Enphase, the solar power stock. This market turned against solar because there was so much garbage pumped out by the investment bankers and the SPAC orchestrators that the good ones got lost in a sea of junk. But if you want to own one genuinely disruptive solar play, Enphase is the way to go. Its biggest weakness is that it's boring. But right now, that feels like a high-quality problem. Oh, but get this. It is wildly profitable, okay? Number 9, whoa. Lion's dead. Moderna. Yeah, Moderna's a company that feels a lot like Zoom about 400 points ago. Now, Moderna made a ton of money thanks to COVID, but in the end, they haven't done much with that cash, and they don't have a Pfizer pill. Maybe Moderna will start developing those personalized vaccines that were the focus here before the pandemic, including for cancer. I feel much better if the company used their vaccine proceeds to buy up a bunch of burnout biotechs and transform them into a big pharma name. And that's what I'm betting they'll do, because Moderna itself does not deserve on this sacred 10. And then finally, one that you may not be familiar with, I know because my daughter lived in Oregon. My daughter, who introduced me to this place with the idea that, Dad, I don't want you to sleep on Saturdays anymore. You need to be able to go Friday to Sunday because you don't get to see me much. Dutch Bros. Yeah, I'm always searching for retail or restaurant names that are popular in a particular region, Oregon, even as most people have never heard of them. I have no doubt that Dutch Bros, and some people call it bro, I don't mind that. The Dutch Bros model of kiosks in parking lots is a winner. Unless it's Christmas, malls have way too much space and so little revenue coming from their parking lots. Along comes Dutch Bros with a booth in the parking lot where some of the best tasting coffee can be had, served by surprisingly cheerful young people. People like their caffeine, but most coffees seem to want to hide what we need it for, work, not Dutch Bros. They have the Annihilator. That's the best tasting caffeine delivery system in the nation. Of course, this stock's been obliterated because it's a recent IPO. But if you buy the stock now, you're benefiting for all the prospective future stock buyers who haven't seen a Dutch Bros, let alone know that there's going to be another 1,000 of them added. Because we all want our caffeine to keep us awake and do better. The bottom line, I wish there were more stocks in the CNBC Millennial 50 list that I could endorse here, but the market's changed, and you have to change with it. You may have too many expensive stocks in your portfolio, including 600 that came public in the last year, of which I would throw every one of them into the Love Canal, the Gowanus Canal, and that great Waste Management. Waste Management's got some unbelievable giant mountains of trash just on the other side of the Hudson. They're just great landfills, and you have all those pigeons that come down on you. That's what should happen to the 600. Pigeons should land on them. But now you have 10 that I like. However, I wouldn't pick more than 2 to actually own until the market gets more comfortable with growth names, which will happen if this shakeout ends, but not anytime soon. Yes! And by the way, before I did this piece, do you think I went to Dutch Bros? I just wish I had. You have no idea what it would have been like had I gone there. Stick with Cramer.
Coming up, Cramer's got more than a token interest in making you money. Head off the charts for some crypto crib notes next.